Imagine you are watching a legacy hardware stock. We are talking about a company that manufactures physical spinning hard drives.
Right, the kind of clunky metal boxes that feel like they belong, in a museum
Yeah,
next to floppy disks.
exactly. And a year ago, this stock was sitting quietly at a 52-week low of about $63.
Yep.
You blink, the calendar flips, and suddenly, just days ago, it smashes into an all-time high over $517, which is just
I
wild.
mean, that is a 600% explosion in a single year. It honestly feels like a glitch in the matrix.
It really does. And it creates this massive psychological dilemma for anyone watching the market right now.
Absolutely.
Because value investors see a 600% run in a legacy hardware company and they just assume it's a bubble about to pop.
Yeah.
But then momentum traders look at that exact same chart and view it as a rocket ship that they are terrified of missing.
And if you are listening to this right now, staring at this massive AI-driven rally, you are probably asking yourself that exact question, right? Like, is it too late to get in, or is this really just getting started? Yes, exactly.
So we are going to unpack the financials, the underlying technology, and some highly suspicious insider moves regarding Seagate Technology Holdings.
Ticker symbol STX.
Right, STX. We want to find out if retail investors are walking blindly into an overhyped trap. But before we tear into the balance sheet, a quick reminder to please like this video, subscribe to our YouTube channel, and definitely leave your feedback in the comments below.
Yeah, we read them, we debate them, and honestly, it's pretty much a mandatory part of participating in our community.
Mandatory. Love it.
Also, I should probably set the parameters for this deep dive.
That's a good call.
Our mission today is to separate the hype from the reality using the source material we have. So we're looking at public data, market sentiment, technological trends.
Yeah, this is purely an educational exploration and, a natural debate. We are absolutely not giving financial advice. Never. We read the gauges, you drive the car.
Perfect way to put it.
So let's start by looking under the hood of Seagate's actual business ledger. Because 600% growth in a hardware company sounds like pure, I don't know, dot-com era hysteria.
Oh, it really does.
Yeah.
Back in 1999, you just added .com to your name, and your valuation tripled overnight.
Yeah, and today you just whisper the letters AI on an earnings call, and the exact same thing happens.
Literally.
But a stock price is just a narrative, right?
Yeah.
The income statement is reality. So is Seagate actually bringing in the cash to justify a $517 share price?
Well, so the surface level reality is actually incredibly strong.
Really?
Yeah. I mean, they recently crushed their Q3 earnings estimates. They posted earnings per share of $3.11 when the street only expected $2.77.
Wow, okay. That's a solid beat.
It is. And if we look at the money they actually brought in over the trailing 12 months, they are showing really solid top-line revenue of roughly $9.1 billion.
Okay.
And they're keeping about $1.47 billion of that as pure net income. That's a very healthy 21.2% operating margin.
Wait, and the source material also flags a massive jump in free cash flow, right?
Yep.
Their cash flow is up 281% year over year. I mean, that is the metric that gets institutional investors salivating.
Oh, totally.
They are generating nearly 3 times the raw cash they were a year ago. Honestly, if I stop reading the financial statement right there, I'm buying the stock.
Right. But you can't stop reading there.
The catch.
There's always a catch. You have to flip to the liabilities column.
Yeah.
The cash flowing in is impressive, sure, but the structural foundation of the company is heavily compromised.
How bad is it?
Well, they currently have total assets of about $8.02 billion. But their total liabilities sit at $8.48 billion.
Wait, hold on. So if you are holding the stock right now, you really need to understand what that actually means. Their liabilities exceed their assets.
By about $453 million.
That is negative equity. So if Seagate went bankrupt tomorrow, and they liquidated every single factory, sold off every patent, emptied every bank account, they would still be nearly $500 million short of paying off their debts.
That's the math.
Yeah.
And wrapped up inside those liabilities is a staggering long-term debt load of almost $5 billion.
Yeah.
$4.99 billion to be exact.
Wow. $5 billion.
Yeah. And, in the previous macroeconomic era of 0% interest rates, carrying a $5 billion debt load was just standard corporate strategy.
Right. Capital was basically free.
Exactly. You could roll that debt over endlessly.
Yeah.
But today, debt is expensive to service.
So how do the bulls justify this?
Well, the bulls argue that a 281% increase in free cash flow is more than enough to service those interest payments.
Okay, fair. And the bears?
The bears point out that the hardware market is notoriously cyclical. So any sudden hiccup in revenue means that $5 billion debt load becomes an anvil around the company's neck.
Let me frame this in real life for a second. This feels exactly like a friend who just got a massive promotion at work. Oh, I know this friend.
Right. Their salary doubled. They are throwing around cash, picking up the tab at dinner that is the 281% jump in free cash flow.
Right.
But what you don't see is that they are secretly drowning in credit card debt. They owe more than they own.
That is a perfect analogy.
So if the CEO is looking at this miraculous 600% stock run, knowing they have a negative equity balance sheet, how are the insiders actually reacting to this price surge?
They are reacting by heading for the exits.
Wow, are you serious?
Yeah. The stock sits around $503 as of our mid-April data, and we are seeing clustered high-volume selling from the C-suite.
Like who?
CEO William Mosley, for starters, along with several other key executives, they've been offloading millions in shares.
Just cashing out.
Big time.
Yeah.
Mosley specifically dumped roughly $8.4 million worth of his own shares on April 1st alone.
Okay, I have to challenge the standard corporate excuse here.
Oh, for it.
Because the usual line is always that executives sell for, personal portfolio diversification or to pay taxes.
Of course. But let's use some common sense here. If you are the CEO sitting on the front lines of the greatest technological gold rush in human history, this massive AI infrastructure boom, and you truly believe your company is the indispensable backbone of that boom.
You hold your shares.
You hold your shares. You do not dump $8.4 million worth in a single afternoon just as the stock hits an all-time high.
No, you don't. And it sends a really chilling signal to the market.
Right.
Because the C-suite has visibility into the daily supply chain metrics, right?
Oh.
They see the forward-looking client orders, the internal profit margins.
They know things we don't.
Exactly. They have data that Wall Street analysts won't see for another 3 months. So when multiple executives sell massive blocks of stock at the peak of a parabolic run, it is one of the most reliable indicators that the insiders believe the stock has found a localized ceiling.
So the CEO is cashing out and dropping his bags, but the stock keeps floating. I mean, it hasn't crashed.
Not yet.
So who is blindly buying up these shares at $500? To figure out where this relentless buying pressure is coming from, we kind of have to ignore the fundamentals for a minute, right?
Yeah, you have to look at the algorithms and the momentum traders.
So what are the technical indicators showing?
The charts show a market entirely disconnected from gravity. I mean, the trend is violently bullish.
Violently bullish. I love that term.
It's the only way to describe it. The stock is floating so far above its historical average that the gap itself is a massive warning sign.
Break down the moving averages for us.
Sure. So the 200-day simple moving average, which is essentially the baseline consensus of what the stock is worth over the last year, is way down at $408.
Wow. Okay.
And the 50-day average is sitting at $465. So trading at 503 means buyers are completely ignoring the floor.
What about the momentum indicators, like the MCD?
Yeah, so the MCD, the moving average convergence-divergence, is showing sustained bullish momentum. The math says the trend is pushing forward and there are no falling channels.
Okay, so the trend is still technically pointing up.
Technically, yes. But the oscillators are telling a terrifying story.
Oh, boy.
The 14-day relative strength index, the RSI, is nearing 70.
Which is the classic overbought threshold.
Exactly. And the stochastics indicator is sitting at a screaming 92.08.
Wait, 92?
Yep, 92.08.
Okay, let's make that 92 reading tangible for the listener. Imagine a thick rubber band stretched between the company's fundamental reality and the market's AI hype.
Okay, I'm picturing it.
A stochastics reading of 92 means that rubber band is pulled back so tightly that the tension is causing it to physically shake.
That's a great way to visualize it.
Right. I mean, it might stretch another millimeter or two if the hype continues, but when it finally snaps back to the mean, it is going to leave a massive welt on anyone holding it.
Oh, for sure. Because hitting a 92 means the stock is consistently closing at the absolute microscopic peak of its highest possible range, day after day. You cannot sustain that level of exhaustion without a brutal pullback.
So the technical exhaustion is glaring. The negative equity is public knowledge. The insider selling is documented.
Yep.
Yet if you look across Wall Street, institutional analysts are pumping the stock.
Heavily. Over 19 analysts maintain a moderate buy consensus.
And they are setting some crazy aggressive price targets.
Yeah, Morgan Stanley named it a top pick with a $582 target. Mizuho is at $565. And Bernstein is pointing all the way up to $620.
See, this is where I just lose the plot. The stock is currently trading at a price-to-earnings ratio of roughly 54.6.
Right.
A PE of almost 55 means investors are willing to pay $55 for every $1 of current earnings.
Which is incredibly high for a hardware company.
Exactly. I understand giving a software company a 54 multiple, because if a software company builds a great app, the marginal cost to sell one more subscription is literally zero.
Right, they just duplicate the code.
Yes. But Seagate manufactures physical heavy metal boxes. To double their revenue, they have to double their factory footprint, buy twice as much rare earth metal, and pay for twice as much global shipping logistics.
It's a completely different business model.
Giving a physical manufacturing company a software-level valuation fundamentally misprices the physics of their business. So why are analysts doing it?
Because Wall Street is fully aware of the physics, but they are pricing in a totally different economic paradigm.
How so?
The institutional analysts are arguing that Seagate is no longer just a legacy hardware manufacturer. They are valuing it as an inescapable bottleneck for the artificial intelligence revolution.
The AI data center build-out.
Exactly. AI models like the ones generating video, text, and code require incomprehensible oceans of data to train.
Right.
And every single parameter, every piece of training data has to be stored somewhere physical. As the saying goes, the cloud is just someone else's computer.
And that computer needs hard drives.
Precisely. So analysts believe the sheer explosive demand for AI storage will force tech giants to buy Seagate drives at basically any price.
Rendering that sky-high 54 PE ratio actually cheap relative to their future earnings.
Right. If STX delivers, it might actually be undervalued relative to its potential. That is the bull thesis.
Yeah.
But it introduces the risk of a classic value trap. Or growth trap, depending on how you look at it.
Because if they miss...
If the AI build-out slows down even slightly, or if tech companies find ways to train models with less data, Seagate's forward earnings will miss expectations.
And when a company with a 54 PE misses earnings.
The multiple contracts violently. Retail traders who get lured in by Bernstein's $620 target, who buy the stock today at $503, will see their portfolios get crushed by volatility.
Cut in half overnight when the market reprices Seagate back to a normal hardware multiple of like 15 or 20. So we have to formally weigh these two opposing realities. We have the AI narrative versus the physical reality of the balance sheet. Let's dig into the actual mechanisms of the bull case for a second. Because they aren't just relying on market hype, they have a massive strategic shift happening internally with something called AMR technology.
Yes. AMR, or heat-assisted magnetic recording, this is really the bedrock of their future growth strategy.
Break that down for us. What does it actually do?
Well, for decades, the hard drive industry has struggled with a physical limitation. You can only squeeze magnetic bits so closely together on a disk before they become unstable and corrupt each other.
Right, the data just gets too crammed.
Exactly. So AMR solves this by attaching a microscopic laser to the recording head.
Wait, a laser on the actual hard drive head?
Yeah, it briefly heats the exact microscopic spot on the disk where the data will be written. And that heat changes the metal's magnetic coercivity for just a fraction of a second.
Oh, wow. So it softens the metal, writes the data, and then as it instantly cools, the data is locked in at a density that was previously, physically impossible?
Precisely. And in a massive data center, physical space and electricity for cooling are the two biggest expenses.
Sure.
If Seagate can use HAMR to cram 30 or 40 terabytes onto a single drive that fits in the exact same physical slot as an older 10-terabyte drive.
They solve a massive logistical nightmare for companies like Amazon and Microsoft.
Exactly. And that is why Seagate abandoned their other less profitable ventures to focus purely on high-capacity HDDs.
That is a phenomenal evolution of the technology. I'll give them that.
It's huge.
But here's where it gets really interesting. I was digging through our sources, and there is a wild card risk that could completely derail this entire HAM narrative.
Oh, yeah. The technological disruption threat.
Yes. Everyone is obsessing over Seagate's $5 billion in financial debt, but almost no one is talking about the risk of technological disruption. The sources specifically call out the looming threat of Google's TurboQuant.
The shift from magnetic storage to quantum state storage. It's the existential threat hanging over the entire legacy hardware industry.
Think about it. If you are selling software and a competitor releases a better version, you just pivot, right? You update your code.
You push an update.
Exactly. But Seagate has spent billions building factories specifically designed to manufacture magnetic spinning disks.
Right.
If Google or another tech giant introduces TurboQuant, a technology that theoretically uses quantum states to store data at a density and speed that makes mechanical drives look like stone tablets.
Seagate's entire manufacturing infrastructure becomes obsolete overnight.
Yes, those billion-dollar factories instantly turn into extremely expensive paperweights.
It's a terrifying thought for investors.
Because you can renegotiate financial debt with a bank.
Yeah.
You cannot negotiate with technological obsolescence. It is fatal.
And it exposes a massive flaw in Wall Street's $620 price targets.
How so?
The analysts are modeling exponential infinite demand for data storage, but they are assuming the technology used to store that data remains entirely static. And history shows us that explosive demand and massive bottlenecks are the exact catalysts that accelerate disruptive innovation.
Yeah, that's a great point.
If a major client like Google figures out how to store data more efficiently without using spinning magnetic disks, Seagate's entire total addressable market evaporates.
So let's synthesize this tension for the listener because there's a lot to process.
Yeah, let's pull it all together.
We have an incredibly bullish macroeconomic AI narrative, right? Explosive data center demand and the promise of AMR technology.
Yep, that's the best case recovery and growth scenario.
But on the other side, we have $5 billion in debt, negative equity, extreme technical exhaustion with the stochastics of 92, heavy insider selling, and the looming shadow of quantum disruption like TurboQuant.
That is quite the bear case.
So what is the actual outlook here? Let's break it down into the short-term and the long-term realities.
Well, in the short term, the market is a psychological arena, not a logical one.
Very true.
The stock is highly volatile, but it's currently biased upward because the broader market sentiment is dominated by extreme greed and optimism.
And we have earnings coming up, right?
Exactly. Short-term traders are fiercely anticipating Seagate's upcoming May 5th earnings report, and betting against a stock with this much sheer algorithmic momentum before a major catalyst is basically financial suicide.
Right, but what about new entries?
Because the technicals are so violently overbought, entering a new position at 503 leaves you incredibly exposed to a sudden, sharp pullback.
Just from normal market breathing.
Yeah, the stock could easily drop 8% just to return to its 50-day moving average, and the overall trend would technically still be considered bullish.
Which means buying now is essentially paying a premium just to participate in the anxiety.
That's one way to look at it.
What about the long-term investors, the ones who don't care about a 14-day RSI?
For long-term portfolios, the outlook remains bullish, but it hinges entirely on the macro narrative of AI infrastructure remaining intact.
So May 5th is huge for them, too.
The May 5th earnings report is the ultimate proving ground. Seagate has to prove that the 281% jump in free cash flow wasn't just a one-time cyclical fluke.
They need to show consistent growth.
Yes. They have to show that HAMR adoption is accelerating, and most importantly, they have to prove they're using that cash flow to chip away at the $5 billion debt mountain rather than just, treading water.
So May 5th will force the AI narrative to finally reconcile with the physical numbers.
Exactly. Short-term traders are playing with fire right now due to the technical exhaustion, but long-term investors are treating May 5th as the real test.
Well, we have covered a massive amount of ground today. We explored the dizzying 600% gain that took a boring legacy hardware manufacturer from $63 to $517.
We unpacked the physics of HAMR technology.
And why data centers are desperate for it. But we also stared down the brutal realities of negative equity, a massive debt load, executive cash outs, and the catastrophic threat of quantum storage disruption.
It really serves as a masterclass in market mechanics. It shows how narrative momentum can completely detach a stock price from its underlying balance sheet, at least temporarily.
Absolutely. And as we wrap up, we want to reiterate that everything discussed today is an educational exploration of market forces and source material.
No financial advice was given.
We just lay out the map. But before you navigate this market, I want to leave you with one final lingering thought to mull over.
Ooh, let's hear it.
We have seen that Wall Street institutions, from Morgan Stanley to Bernstein, are pounding the table. They are issuing price targets well over $600, telling retail investors that the AI storage narrative makes the stock a generational must-buy.
Right.
But at the exact same moment, the very CEO who sits in the boardroom, who sees the daily supply chain metrics, who knows exactly how heavy that $5 billion debt load is,
Yeah.
That CEO is dumping millions of dollars worth of his own shares at $500.
The crazy contradiction.
So here is the question you have to ask yourself. When the chips are down and real money is on the line, who do you trust more? Do you trust the analyst whose entire job is to sell a compelling narrative, or do you trust the person actually running the company who is quietly heading for the exit?
That is the ultimate question.
Let us know whose side you are taking down in the comments. Don't forget to like this video and subscribe to the channel so you never miss a deep dive. Until next time, keep questioning the narrative.